All right. Hi, everyone. Welcome to another episode of Money Monday. I'm very excited to meet you guys today, to speak to you guys, because today we're going to be talking about today's dip in the stock market. Give me 1 second. I'm going to just share this video to my Facebook page really quick. And while I'm doing that, I'm just going to mention a couple things that we have coming up. For all our clients, we do have another we had our monthly mastermind last week, which is why I wasn't here doing Money Monday. But our next monthly mastermind is going to be on August 9th, so be sure to join us for that. Also, for clients, we have another meeting of our book club this week on Wednesday. Now, let me share this. Boom. Awesome. And one other thing is that we actually I'm not sure if you viewer know this, but we actually also have a YouTube page. So I invite you to go to our YouTube page. I have the link in our description today. Go to the YouTube page, subscribe to us. We have all our Money Monday videos right on there. It's an easily searchable format. So if you're wondering, hey, you know what? How do I open an IRA? You can search it right on there, and it'll come up for you. So go ahead and subscribe to us on YouTube. And again, if you find this stuff useful, please share this. We want this information to get out there because this is going to be useful information that helps everybody. And we believe in that phrase that a rising tide lifts all boats. So let's talk about today's dip in the stock market. Something I'm actually going to be doing is I'm going to actually share screen here so you can all see what happened today. I'm going to be showing just, in case you haven't seen one of these before, this is going to just be a regular stock chart, basically. And I'm going to compare a couple things that happened today. So boom, here we go. All right, so this is the S&P 500. If you're not familiar with the S&P 500, it's basically the 500 biggest companies in the stock market, and it's measuring how did they do, how are they performing. As you can see, this is the past 5 days, 5D. We have it was actually on a little bit of a downward trend already, but then basically once the weekend hit, then suddenly, boom, we dropped. It was about almost 2% at one point during the day that it dropped. Let's look at the 1 day chart. You can see it's dropped about 1.5% since the close on Friday. This has a lot of people nervous, and there's been a lot of speculation about why did this happen. There's a lot of theories being floated out there, including basically investors are still worried about recovery, and the Delta variant picking up, and the rising Delta variants got people worried, so they pulled money out of the stock market. People are sometimes what happens, we didn't see it so much today, but sometimes what happens is as people start seeing stocks starting to go down, especially short-term investors, day traders, they want to cash in and get their profits right away. So they immediately start selling, which actually drives down the stocks even more. And it will keep going up until it'll keep going down until somebody says, until enough people go, you know what, we're actually getting a good deal here. This is it's worth it to jump in at this point. And that's how the stock market becomes efficient, because there's a level at which people go, cool, awesome, I'm willing to pay this much to take on that amount of risk. As you can see today, it happened, just right around here, where they say it's support, but basically, because the stock market is efficient like that, at any point in time, that stock price that you're seeing, that's the value that people are putting at it. There's enough people buying in and selling stock at that point where people are saying that becomes the value that is correct for given all of the information that we have about the stocks. So I've heard people feeling a little bit worried about this dip in the stock market. Been talking to people, and they are wondering, should I buy the dip? People start questioning things and start thinking, should we suddenly revamp our entire investment strategy, that kind of thing. Some people are just feeling really bummed out because, especially if you're a short-term trader, you're trying to get profits every single day. When the market's going down, it's a lot harder to do that. So, what can we learn from this? There's a word I'm going to tell you and I'm not sure if you've heard it before. It's diversification. It's a basic stock investing strategy, being diversified. And what basically means is not having all your eggs in one basket. So you want to have, and that's common sense knowledge from ancient farming. You know, you don't want all your eggs in one basket, because if the basket falls, suddenly you lose all the eggs, or you lose a bunch of eggs. Eggs are fragile. Stocks are like eggs. They're a lot more risky than anybody really even realizes. So we have to try to protect ourselves from dropping those, from a drop in the stock market like this. Can you imagine what it would be like if you were just about to retire, and then suddenly you were invested in stocks, which again are very risky, and then suddenly you saw the stock market, COVID hit or something like that, and then suddenly the money that you're going to be counting on for retirement suddenly goes. That could make anybody's stomach suddenly flip. That's terrifying. So what we want to be able to do is have a strategy already in place, so that when things like this happen, it doesn't matter. And sometimes you even actually turn a profit because of it. And again, that comes from diversification. One of the things that I'm also going to be, I'm going to also point out is that, we're seeing this overall drop in the S&P 500. That means that there are some companies in the S&P 500 that dropped a lot more than that. Some might have even gained. This is just kind of the average, trying to take the overall picture of what all the companies did. So again, S&P 500, you're already diversified across 500 companies. So that's fantastic. If you only had if you were only bought into one company, that's like not even just having not even just having one basket. Everything is in one egg at that point. And that becomes very dangerous, because if you drop that egg, you're kaput. So we want to invest in a diverse amount of companies, and we also want to diversify across assets as well, asset types. And that's what we're going to talk about today. What kind of strategies can people use to try to protect themselves from days like today, when the stock market is going to drop? Because guess what? It happened today. It's going to happen again. The stock market goes up and down, and that's what the stock market does. A lot of cases, it's cyclical, So this is going to happen again. People have been talking to me about how they're worried, they're bummed out, and to me, this is another Monday. Sure, the stock market's going to do what it's going to do. This is why we diversify, so that when things like this happen and everybody else starts panicking, you have something that you can fall back on, and you know that your overall portfolio is not going to be doing this this ka-chunk right here. So what does that look like, and why does that work? Well, let's talk about some different asset classes. We got stocks, which is the S&P 500, also called equities. You might have heard it called. We also have bonds and real estate also. Also, real estate is another type of asset. So bonds, let's start with bonds. Bonds are not as sexy as stocks. When people come to me and they start talking about investing, people are usually not talking about bonds, because people want the really flashy, stocks. I want to be able to make a lot of gains all at once. Bonds are the stability that you can build into your portfolio, and they're important because they are what's called negatively correlated to the stock market. What does that mean? When the stock market goes down, bonds usually go up, because people are pulling out of the stock market into less risky things like bonds. That makes the value of bonds actually go up. I'm actually going to show you this right now. Let's start out with first though. This is real estate. Let's start with this guy right here. This is an equity fund, Vanguard. Vanguard's a really good company. A Vanguard equity fund. As you can see here, this is the last 5 days. It doesn't even capture what happened today yet, but you can see last week it was just going down. The reason why this doesn't capture today yet is because mutual funds are priced at the end of day, and so Google just hasn't gotten the information about the end of day today yet. So like I said, As you can see, last week, stocks were typically on a downward trend. That was even before the drop over the weekend. But how did bonds perform? Boom. So you can see here, bonds did not behave the same way that stocks did. They both went down. The bonds went down a little bit on Friday, but for the most part, whereas stocks went down last week, bonds went up. So what would happen if you had both of these combined in the same portfolio? Depending on the mixture you had, your portfolio would have either stayed the same, or if you're close to retirement and you already have a lot of bonds in your portfolio, would have actually gone up, because you can see that it actually went up a little bit. So that's how you can actually protect yourself. So bonds, again, not sexy. They aren't exciting, but what they are is they are stable. And what you want when you're investing is that stability. Well, number one rule of investing, you might have heard me say it before, don't lose money. Incorporating bonds into your investment strategy is one of those ways where you can help protect yourself from days like today, so you won't lose money when there's a sudden dip in the stock market. I'm going to also just briefly show you real estate. I kind of tipped my hat a little bit earlier. This is the real estate index fund. Again, doesn't capture today, so I'm not sure what it would have done today. But you can see it's just another type of asset class that performs differently from stocks, and also it performs pretty different from bonds too. You can see that they both went up, but not necessarily the same way. And this stayed flat on the last day, whereas bonds went down a tiny little bit. And again, this is, and I'm not here saying that people should suddenly put all their money in real estate or suddenly put all their money in bonds. I'm here saying that what we're trying to do, the goal is to be balanced amongst all these different asset types. If you have a little bit in each, if one goes down, chances are they're not going to all be dropping down at the same time. So that's a way you can definitely protect yourself from a dip like today. I'm going to show you a couple ETFs at the same time while we're here. Let's see. This is the total bond market ETF. ETF is just priced slightly different. It's priced differently than mutual funds, so they actually do have a price during the day. You can buy and sell them during the day. They aren't just priced at one point. Because of that, we can see that the S&P 500 took a dive right there. Meanwhile, bonds reacted the opposite way and actually went up. Again, this is a way that you can protect yourself from the stock market doing this. And then the one other thing that I wanted to, and then this is the total, just so to make it even, again, Vanguard's a really good company. So I just wanted to show ETF to ETF exactly how they compare. And you can see that they are not exact opposites, but they're pretty close. And that's what you can use that to your advantage when you're creating your investing strategy. So that way, again, you're not losing as much money. You don't have to gain back as much ground as you lost, and you're going to be able to actually make more money. One of the other things that I want to touch on here is that you can see I'm using the total stock market ETFs, bonds, and stocks and bonds. We're talking about diversification here, making sure that the investments you hold are across a variety of companies. One of the things that a lot of people have have told me and that they want to do is investing in specific sector ETFs or sector funds. It's a way that they feel very connected to technology, to transportation, things like that. It's almost, you can hear it when I'm saying it. So this is the total stock market, and rather than investing in diversifying in all of these companies, people are coming up and they want to invest in only this narrow section of the total stock market, all the companies that are available. You can just hear it. That's not as diversified as if you're buying into the whole thing. because of that, there is the potential for higher rewards, but there's also the much more risk involved than people realize. There's so much more risk involved in buying in a single company and in sector funds than people actually realize. Why is that? Because, for instance, this is today's dip is reacting to the Delta variant. People's expectations for how we were going to deal with COVID. When you're getting into specific sectors, you're suddenly exposing yourself to the risk of what if the government suddenly comes out with a slight tweak of regulation. So then all these companies have to scramble in order to meet the new regulations. Regulation risk is something that's very real for sector funds and individual companies as well. What if for an individual company, what if the CEO suddenly gets hit by a truck? Random stuff. You're suddenly exposed to you have a much higher exposure to very random events happening to a single company or to a section of companies, and that risk that can have very real implications. If you're close to retirement, that can have real implications for how long you're going to actually be able to provide your own income in retirement. Or if you're just let's say you're just let's say you're my age, 31, and you're investing, and you're investing because you want to be able to set yourself up for a goal. Let's say buying a house or something like that. If you're invested in these specific companies and you don't have diversification of assets or anything like that, you're highly exposed to risk. The repercussions of that risk are, if the stock market goes down, then suddenly the value of your stocks go down. Chances are at that point, you're also going to be having a lot of trouble with, you might have, if let's say, for instance, COVID, what happened to a lot of people during COVID? If people only had stocks at the beginning of COVID, suddenly the stock market plummeted. A lot of people got furloughed, people lost jobs, and then they had to rely on their investments to actually be able to see them through until the furlough ended, until the next job. But at that point, they also had a lot less in investments. They got screwed. It was awful. People got screwed. And you might be going, yeah, that was COVID. COVID's not going to happen again. Except that it happened two other times in my lifetime. It happened in 2001 during the dot-com bubble, and it happened again in 2008. People were highly invested in stocks. Suddenly the stocks lost value. Companies had to let people go. Companies closed. And then there were a lot of people that just lost so much. That when you hear the word risk thrown around with stocks, that is those are the very real repercussions of what risk means, of the risk you're taking on when you're investing. And that's why it's important to diversify, to decrease the level of risk you're taking on, even across countries too. So for instance, if you're buying stocks, not just buying stocks in the US, but buying stocks abroad as well. That way, if something happens in the US, chances are that stocks in other countries are not going to go down in the same way. So this is a very real thing. We're seeing a dip today. A lot of people are unhappy. However, if they had approached everything with a plan, with a strategy to diversify across assets, across companies, across countries, across sectors, then this dip that a lot of people are experiencing today would have caused a lot less stress, to the point where, I mean, I heard there was a dip, and I haven't even checked my stocks. Why? Because I'm so diversified that I'm not concerned about it. So I hope one of the takeaways you take away from this is diversification is so important. It's so important to decrease the level of risk you're exposed to something you can actually tolerate. Being able to calculate your risk tolerance is actually something that Plan and Act can help you with. If you're unsure of what a good amount of risk would be for you in your life stage, for the goals that you have, for even your own emotional tolerance, your risk capacity, your risk tolerance, we can help calculate that. So reach out to me. I'm always here. to help you with that. And actually, if you reach out to me, we can actually do what's called we have a free financial assessment that we can do that can actually I'm gonna, it's completely free. If you go to planandact.com, you can actually even do this on your own. Click on Get Started. Also join our newsletter right there. You saw that little pop up there. Click on Do It Yourself. Click on Free, Bronze Free, Get Started right there. What you're going to get from that is a free financial assessment that's going to let you know what your life stage is. And that a lot of times when I go through this with people, it's like, oh, it's one of the first times when we're starting to get everything in one place together, and that clarity, that just gives people a lot of peace of mind. So we'll do you can do the financial assessment on your own, or you can reach out to me. And one of the things that comes out of that is a sample portfolio that you can use to block off how much should I be putting in bonds and how much should I be putting in stocks, because everybody's different. Everybody's at a different point in life, and something like that can really help add some clarity to what you should be doing. A lot of times you go to the websites and they say, oh, what kind of portfolio do you want? Aggressive, balanced, or conservative? And they don't really provide a lot of guidance. What are the things that should play into that kind of thing? Your risk tolerance, your risk capacity. And that's one of the things that we can help identify for you too. So again, planandact.com, go to the Get Started, Do It Yourself free bronze account, and it's completely free. And one of the things you also get with that is a complimentary 1 hour strategy session with a licensed financial advisor. So I invite you to go sign up for that. Start diversifying your investments, and you'll never have to worry about a day like today, or even if we have another day like in another month like March last year, you won't have to worry about it because you'll be so diversified. You'll go, stock markets are down. That means everything else has got to be doing pretty well, and you'll be feeling pretty good about it. Thank you all so much for joining me. This was another episode of Money Monday. Again, my name is Henry. I am your friend in finance. I hope you guys have a wonderful week, and I will see you all next week. Have a good day.